Thank you all very much for joining us this morning. My name is Ron Lake. I'm from Lake Partners. I'll be the moderator for today's event, which is part of the ongoing series of the Greenwich Roundtable. To our topic, which is Asked Allocation for 2002, the navigating the risks and charting the opportunities. I'd like to introduce our panelists. First, sitting next to me is Doug Cliggot, who is the managing director of J.P. Morgan and the firm's chief equity strategist. He heads the U.S. market strategy team at Morgan, and which he joined in '96 after being at Merrill Lynch, where he was manager of the global investment strategy effort. And he also holds the world record for repeat performance here at the Greenwich Roundtable, having appeared here just in July to talk about technology. Next to Doug is Don Coxe, who is our surprise guest, who we added to our roster. He's chairman and chief strategist of Harris Investment Management and has direct portfolio responsibility for their pooled pension fund and large cap value, and also the Harris Insight Equity Fund, which is also in large cap value. And I should also mention that this may be a context or prelude to what he might have to say, that his first job having come down to the States from Canada was working for the National Review. He was an associate editor. Next to Don is Spencer Lampert, who is managing director of Tudor Investment Corporation. He's in charge of the market strategies department, which works on researching and instituting many of the firm's investment strategies. And he's been there for, 14 years now, having initially created the firm's global equity trading department. Doug might hold the record for quickest repeat performance here at the Greenwich Roundtable. Spencer holds the world record for a number of appearances. This is fifth. Truly a world record. Thank you for joining us. And next to Spencer is Todd Petzel, who is president and chief investment officer of Common Fund Asset Management. Prior to joining Common Fund in '96, he was executive vice president at the Chicago Mercantile Exchange, and among other things, is the author of the book Financial Futures and Options, A Guide to Markets, Applications, and Strategy. So with those introductions, let me turn it over to Doug to start us off on our discussion.
Thank you, Ron, and my sincere thanks for inviting me back again so quickly. Many of you may have a packet of paper with the title "Be Careful" on it. It's what I would like to structure my comments around. I guess what I would like to do is talk about three things. One is how difficult it's going to be for the Federal Reserve to influence events here over the next 6 to 12 months. Then second, try to link core profitability in the United States to American households' asset allocation. There seems to be a pretty robust linkage and one that makes us very concerned about what the average American is likely to do next with their equity holdings. And then third, throw out a very crude valuation model between stocks and bonds and give I guess what I would call a short-term perspective, meaning the last 10 or 15 years, and then a long-term perspective, meaning the last 40 years, in suggesting that they indicate wildly different outcomes for the equity market, depending on whether we will start to migrate towards an equity risk premium that is more like a 40-year average rather than what we've been living with for the past 10 or 15 years. On the first chart first page of charts, there's two illustrations, very simple illustrations. One is labeled MB and GDP. MB is the monetary base. It's the very narrow monetary aggregate that the Fed has complete control over. You can see how they exploded growth in the monetary base in 1999. It was our view then that a huge amount of this liquidity found its way into the NASDAQ, and one of the reasons the NASDAQ went where it went. You can see how it clearly slowed dramatically in 2000, and we think that's one of the reasons the NASDAQ is doing or did what it did in 2000. They're exploding the monetary base again, and that's fine. The problem is we have a hard time figuring out where the money might go this time. We're almost certain it won't be the NASDAQ. It's very rare for people to make a leverage bet on an asset class that's falling like a stone. Honestly, it's hard to find an asset class right now that's going up a lot. Maybe it ends up being real estate away from urban centers. I have no idea, but I think it's a very, very low probability outcome that the liquidity the Fed's creating now is going to go into equities. If we look at the most recent liquidity cycles, when they grew liquidity sharply in 92, 93, it went into the bond market. Bonds were in a bull market already. The excess liquidity led to leverage investing in bonds in the early 90s. That ended in tears in 94, but maybe that's where this liquidity goes this time, is the bond market. Back in 86, 87, I think a lot of the excess liquidity created went to residential real estate. That ended in tears in 89, 90, 91. This liquidity will go someplace. Be careful buying where it's going unless you're a shrewd trader. The bottom chart on the page shows bond yields, nominal 10-year yields, real 10-year yields. This is the reason we think the Fed's in such a bind here. The way the U.S. financial system is structured today, the way you can really reliquefy American households and make us start spending again, even while we're losing our jobs, is if we can do a lot of mortgage refinancing. The problem is we've had 10-year yields where they are right now a couple of times before. So there aren't many people out there sitting with 7% 30-year mortgages that can be refied. In our view, we really need the 10-year Treasury yield to come down to about 4.25 to open up a pool of mortgages that's really going to turn things around in the near term. Maybe that happens. Certainly the price action in the Treasury market this week isn't favorable for that outcome. I think you've got non-U.S. investors selling U.S. bonds this week, and I think people are starting to get spooked by the size of the checks the federal government's going to be writing over the next 6 to 12 months. But I think for us, a key variable, both for trying to guess what's going to happen in the economy as well as what's going to happen in the financial markets, is watching that 10-year yield. Lower is better, higher is bad. Pretty simple. On the next page, there's two other illustrations that again drill down a little bit on why we need long-term interest rates to fall if we're going to get the U.S. economy going again. The top chart shows the value of residential mortgages relative to the value of residential real estate. We look back on clearly a 40-year time perspective. As a society, we've decided it's safe to have a lot of leverage in our home. A real change occurred in 1986 when tax law changes resulted in the only interest we could deduct was interest on debt on our home. But be that as it may, it's quite clear. We've driven our debt-to-equity ratio in our homes very close to 1-to-1 now. And I think what we're fascinated by is how the trend in this line has really mimicked the equity market. It did very well in the 60s. When the market did poorly from the late 60s to the early 80s, it trended down. And sort of in the fantastic bull market from 82 to 99, we just drove leverage in our homes straight up. So there may be an uncomfortable correlation here that if the market stays under pressure, our willingness to leverage our home more is under pressure as well. But I think without trying to guess at behavior, what we do know, and this is the bottom chart on page 3, is that it's already, we're using a lot of our current income to service our existing debt. This data set ends in the first quarter. We were already spending over 14% of our monthly income to service what we had already borrowed. That was back at a 20-year historical high. So again, I think the age of cash out refi activity might be behind us. If we do get a break and we get a nice bond rally and a lot of Americans can refi, my guess is what we're going to be doing is trying to lower our monthly payments rather than buying boats and cars from the equity we can take out of our homes. But I think with that as the framework, our guess of any kind of robust economic recovery next year led by the consumer, the probability of that is very, very low in our eyes. On the next page, on page 4, if I could ask you to look at the bottom chart, this shows the composition of household financial assets over the past 40 years. The thick line that's now on the top is stocks. The next line is cash. The bottom line is bonds. A lot of my peers highlight the mountain of cash out there in money funds that's just burning a hole or potentially burning a hole in people's pockets to get back into the equity market. Our own humble opinion is you've got to have a very limited sense of history to think there's a lot of cash out there. This illustration shows that on any kind of time horizon that extends beyond 5 years, American households actually have very little cash on their balance sheets relative to other financial assets. Stocks are still very, very high, again, in comparison to anything other than the past 3 or 4 years. And so our thinking is stocks are headed down as a share of household financial assets. Just to put this in context, and I apologize, it's not real-time data, but Fidelity told the New York Times a few months ago that the average asset allocation in their 401k programs, and they are the largest manager of 401k programs in America, the average asset allocation was 81% equities at the end of 2000. I think given the returns equities have generated, I would want to suggest that that's a very imprudent allocation and likely to come down over the next year or two. Whether it's a passive change or an active change, I guess, remains an open question. The chart on the top of the next page has been our real focus for several months now, several quarters actually, and this is the one where I think is the core of our very, very cautious stance on profits, on the economy, on equities over the next 12 to 18 months. And that is that profit margins, the thick line in this top chart on 5, are falling like a stone. They're falling like a stone because revenue growth is slowed, because compensation costs are still rising, labor compensation costs are rising faster than revenue, because interest expense is rising faster than revenue, because depreciation charges are rising faster than revenue. It takes time to bring down interest expense. It takes time to bring down depreciation charges. They're a legacy of decisions we've already made. The only thing that corporations can manage in real time are their labor costs, and that's the reason for putting the second line on the chart. That's the unemployment rate. It's on an inverted scale. We've had 7 profit cycles since 1950. On average, the unemployment rate in those 7 cycles has gone up 3.7 percentage points from bottom to top. The low this time was 3.9. If we have an average labor market reaction, it would suggest the unemployment rate in America is going to go to 7.6. The smallest increase in the unemployment rate was 2.3 percentage points in 1960-61. That would, if we replay that, it implies the unemployment rate going to 6.2. Now, needless to say, we think there's a tremendous risk that the unemployment rate goes a lot higher from the current 4.9%. No one wants to fire people in this environment. But at the end of the day, we're running businesses, and I think running a business that's running into the ground doesn't help anyone. And so I would guess that the news flow over the next 3, 6, 9 months is going to be one of a fairly relentless shedding of labor. Now, if it's possible to look at pages 4 and 5 side by side, I'd just like to highlight something that's pretty uncomfortable. And that is, you can see that profit margins, the chart on the top of page 5, peaked in 1966. The bottom chart on page 4 shows that equity ownership peaked 2 years later in 1968. Profit margins bottomed on a secular basis in 1982. Equity ownership bottomed in 1984. Profit margins peaked in 1997. Equity ownership peaked in 1999. And I don't know when or where profit margins bottom, but I don't think it's going to be easy to replay the wonderful increase in profit margins we saw in the 1990s. We came into the 90s. Corporate America had done very little new investment in the 80s. It had very, very clean balance sheets. We had a labor force that was glad to have a job. Very, very different pictures than today. Things might change very quickly over the next 18 to 24 months. But I think if there is one legacy of last week's horrific events, it's probably that a lot of corporate America is going to end up spending a lot more money on security, maybe replaying what a lot of corporate America did in the 1970s and early 80s, spending a lot of money on pollution control. You had to do it. Of course you had to do it, but it didn't bring anything to the bottom line. It added cost without increasing productivity or increasing profitability. And so I think it's very, very tough to be optimistic about the medium-term earnings trend coming out of this cyclical slowdown. Finally, on 6 and 7, page 6, the top chart, it shows a very volatile line and some smooth lines running through it. This is very crude. Most people doing what I do use some variation of this. It's the earnings yield of the S&P relative to the 10-year Treasury yield. This chart just shows the sort of moving, the spot earnings yield, bond yield ratio. It clearly has been very volatile. The middle line, smooth line, is the 7-year moving average. That's what we've used for a long time as our guess at fair value. And the reason we picked 7 years is that's been the average periodicity of a complete earnings cycle in America. The bands around it are plus or minus 1 standard deviation, and when we go above or below it, we tend to recommend an asset allocation change. Now, the table on the bottom of this page gives an array of various earnings numbers going left to right and an array of various 10-year Treasury yields going top to bottom. The far right-hand column, I've bolded 902. Our guess at reported net income this year is $28 a share. To put that in context, last year that number was $50 a share. This isn't a radical guess. The run rate on reported net income in the first half of this year was $14. So we're not embodying a dramatic decline in profitability in the second half of this year. The reality is we were in a very, very dramatic earnings recession before last week, and it's hard to imagine last week is going to make it better. But if we had a 450 Treasury yield and earnings about as we expect, something around 900 on the S&P would be fair value. Our guess at earnings on a reported net income basis for next year is about $34. let's give it the benefit of the doubt and say it's 36. Fair value would go up to something like 1,100 at the end of next year if we get a good earnings recovery in the second half of next year, and I think that's a very big if. So where we're sitting right now, we think over the next 12 months you'll be very, very lucky if your equity portfolio is basically dead money. If you're tracking an S&P index fund, we would expect the S&P to do no better than finish next year around where it is now. Now that's the best case scenario in our eyes. Because if I could ask you to turn one more page, the top chart on this page, same relationship, earnings yield, bond yield, but instead of just a bull market valuation, it looks at 40 years of data. And over the last 7 years, over the last 15, 18 years, the ratio of the 10-year earnings yield has been about 70% of the 10-year Treasury yield. Over the past 40 years, the average has been exactly parity, 1.0. And so that's how we've constructed the table in the bottom of this page. Assuming we migrate back to an equity risk premium that's more like the 40-year average rather than just the one that we've been living in the past 10 or 15 years. Instead of 902, that if you match $28 a share with a 450 10-year yield, we get 622. I hope we don't go there, but it's when we're between 600 and 700 on the S&P 500 is when I will be increasing my exposure to the U.S. equity market, and not really before that, because I think the risk is that's kind of where we're headed. We've got a published year-end target of 900 based on the prior page. We've said in print we think the market will go through 900 and bottom someplace lower than there, hopefully next spring at some level that we don't really want to hazard a guess. But in terms of increasing your equity exposure, we wouldn't do it until we were something like 10, 15, 20% below the 900 level, so that there was plenty of room for analytical risk built in. So what do? We're worried about bond yields going up because of all the Treasury financing. We're worried about stocks going down. I guess we've got a very uninspiring recommended asset allocation, and that's a lot of cash. So on that cheery note, I will.
Don?
First, I'd like to thank Ron and the folks who organized this for having me back yet one more year. I'd also like to thank our first two speakers for providing me the opportunity not to be the most bearish person on the dais. It's a position I've held for the past couple of years anyway. Also, first let me say that many of my friends over the past few years have heard me say that if you really love what you do, you should have no problem getting up in front of a room full of people and talking about it for 10, 15, 20 minutes. Today is certainly going to test that statement I've long held to. I do love what I do, but today is probably one of the most difficult meetings I've ever had to speak in front of. And it would be very easy for me to be very bearish right here. The stock market's going to open down another couple of percent today. At least that's what it looked like as I was driving here. But I can't get myself bearish. And it's not out of some sense of patriotism. Curiously, when I looked at the markets, the price action of the markets, and I said, don't just show me the war years, just let's go back till 1929. Actually, I went back to the turn of the century in the Dow Jones. And I said, show me some of the price action that we've been doing, just very specifically. And the top periods that came up were December 19, obviously 41. Right after Pearl Harbor, curiously enough. May of 1940, that was the invasion of France. I believe it was December 1914, curiously, after the U.S. equity markets had been closed for several months. Clearly information flowed a little slower back then than it does now, so I'm not sure closing a couple of months is all that different from closing for a week these days. And what it showed in each one of those instances is that we were damn near, within weeks of a tradable rally in the stock market. Now, I don't mean tradable for our type of firm, which, as many of you know, is fairly short-term oriented. In fact, usually the first 2-day bounce after the onslaught we've currently suffered is a good selling opportunity. And I wouldn't be surprised to see that happen too. I wouldn't be surprised to see 2 snapback days and then we go back to the old lows or further down. But I think some point in the next 3 or 4 weeks, you will begin to see the first tradable rally, which is a multi-month rally in the stock market. I don't believe it's going to be a V, like many people were talking about a recovery not too long ago. I was a doubter of that, and I'm a doubter of a V-shaped return in the stock market. I think it'll be choppy, and I believe the managers whom you have money with that are stock pickers as opposed to growth-oriented will probably do better in the coming environment. The Fed has supplied literally infinite liquidity to these markets, and they stand ready to continue to provide funds. Prior to September 11th, we were in the most stimulative environment, both fiscal and monetary policy, we'd seen in over 20 years. That has now been ratcheted up. I would not be surprised to see the impact of all that stimulation, which is ongoing. There's going to be more. Just told you what's going to happen in the next 3 months, 3 to 6 months. Doug said nobody wants to fire anyone, and he's absolutely true, but they're businesses. I think the airlines and corporate America after this are going to, sadly, use the events of September 11th to make stunning announcements. I was personally blown away when Nortel wiped out 10 years of profits in one fell swoop. I was almost as stunned the other day to see 30,000 Boeing employees, countless American, United, Continental employees. This is the third and fourth quarter announcements you're going to see from corporate America, I think, will be equally stunning. No one's going to blame them. Everyone's going to blame terrorists in the Mideast. And it's not going to be pretty. So the environment is one that's going to be extremely choppy, extremely volatile. If you ask me what's my favorite trade out there, it's still staying along the U.S. yield curve. Actually, yield curves in the G5 countries. Right now, our 30 or 2-year yield curve, well, I didn't see it this morning, but it was in the neighborhood of 300 basis points. If you looked at the past recessions, it didn't stop until generally 375 to 450 basis points. So we've got a lot more curve steepening to go through. It's funny, Douglas mentioned the 4.25% yield on the 10-year. Well, as a result of the actions last week, we've had global trader meetings every morning. And after yesterday's, one of our top traders in London called me up and goes, Spence, what do you think of the U.S. 10-year? Because it was acting horribly. Everyone knows that the front end of the U.S. curve was acting phenomenally. The curve was steepening every day like we'd never seen it. And I looked at him and I said, I don't understand why either the 5-year or the 10-year isn't the best piece of paper to buy right now. So they're selling it off, that's fine, but I've got to tell you, between now and the next 6 months, economically things are going to get worse. I think the President and the administration have done a wonderful job trying to gauge people's expectations to not expect a quick victory. I think they need to do that, because the worst thing that could be happen has already started to happen. You've seen the bounce in the presidential approval ratings, which usually foretells a bounce in consumer confidence. The worst thing that could happen is to get people's hopes up and then see it wither away. The administration is doing exactly the right thing. Get people's expectations down. This is a war. And quite honestly, as far as I'm concerned, not unlike other wars, it's a different enemy, which means their tactics are different. But it's an enemy nonetheless, and it's going to take the global effort of a unified invading army to defeat them. We've been there before. Different enemies. And we will prove victorious. It may take a few years. If you look at the stock market in December 1941, we certainly didn't win that war for a few more years. The stock market didn't do too bad soon after that. I worry that people expect the stock market to provide the returns that we did when George Sr. was in office in Desert Storm. I don't see that happening, but I do see the stock market going up. Globally, the economies are going to have a hard time. The U.S. is a huge engine to the rest of the world. Right before September 11th, early September, I sent around a trade idea to our traders around the globe, and I said, let me get it straight here. The U.S. yield curve's around 85, at the time, 85 basis points. It was 125, 130. Canada was 130. Japan was 130. Germany was 80, 85. England was 3 basis points. And yes, they're an island, but not unto themselves. And certainly events soon after have seen the UK yield curve move out to 30 to 40 basis points. Still cheap. Because the rest of Europe's now gone back to where we were before September 11th. England's going there too. So I'm more constructive on the yield curves because economically over the next 6 months, as my two earlier speakers said, are going to be very difficult. I think you're getting the levels in the equity market. We just took out, we approached yesterday and this morning going to be taking out the October 98 levels in the NASDAQ. We're approaching it in the Dow. That's where you said it all began. That's going to be a nice point for people to start pivoting around and leaning against. As for the dollar, I think the dollar will have a hard time going forward. The selling over the past few days, from what we've been able to determine, is coming from Europe and overseas. There have been some mutual fund liquidations here, but by and large, a lot of the flows have been out of European funds. And clearly, they will probably repatriate some of the money back home, which is euro supportive. I don't see the dollar being a big mover one way or the other. I could argue it both ways. I could say, U.S. troops invading is bullish the dollar, or I could say the economy is bearish the dollar. I don't think there's a great trade there. I don't think that's going to impact people's trading ideas. I think other things are of greater significance. As for commodities, I agree. Wars are inflationary, and quite honestly, inventory levels across not all commodities, but across a lot of commodities are ridiculously low. We have the lowest registered gold stocks in many years. Now, we all know gold doesn't disappear, and there's a lot of above ground stocks, but it really takes a while for people to want to liquidate their above ground gold stocks. Base metals. Somebody's going to be rebuilding New York, and at some point, economies will turn. I think next year, the year-over-year earnings announcements are going to look better because third and fourth quarter, we all know first and second quarter earnings announcements are lousy. Third and fourth quarter is going to blow them away, and so next year you're going to have to start to see year-over-years looking better, assuming we can have a positive, not resolution, but at least a positive trend in the war on terrorism. I think that will support the stock market. Crude oil. Everybody's asking about crude oil. OPEC's going to be most severely tested now than at any other point in its history. Saudi Arabia, who's been our ally and swing producer in OPEC, is facing a similar threat internally that we face externally, and that is the rise of fundamentalists. Less so terror on their shores, but it's certainly a threat to their political stability. They are between a rock and a hard place, as are many of our allies over there. So OPEC is going to have its work cut out for it, which, all else kept equal, I think is ultimately bullish the price of crude. And all I can say is, look, this is going to be a very difficult time. I have full faith and confidence in the armies of the world to first slow down and ultimately, I don't think we ultimately defeat terrorism. I think terrorists will always be there. They've been there for thousands of years, and they will be there thousands of years thereafter. But I do think we stand a very good chance of making a significant dent in the army of terrorism that's been built up. And longer term, that makes me friendly to many of these markets.
Spencer, thank you very much.
Okay.
So, a really unique perspective. Give us your view of what's going on out there.
Thank you. I'm going to give my talk in two parts. What I would have told you if this meeting had been held 2 weeks ago, which is just after Steve had originally suggested I come and talk to you, and what I think the events of the last 10 days have done to affect our view of what a proper asset allocation would be. We were carrying 51% in equities, the rest in long-duration bonds. The last 2 years, we had moved up to, that's our highest level we've had in 2 years. We were carrying that since April. And our reasoning was quite simple, that we were going through one of the greatest financial follies of all time, a triple waterfall rise and collapse in NASDAQ. And our work looking at what triple waterfalls are all about indicated that you have to complete the triple waterfall collapse before you really know what a lot of other things are worth. The nifty 50s and the 70s, the oil and gold follies in the early 80s. The Japanese triple waterfall really didn't bottom out, as far as we know, ever. It still goes. So what you don't know is the duration of it. But when we got up to 35% of the S&P in tech and a 350 multiple on NASDAQ, to us, this was one of the most terrifying things in financial history. And it was obvious also it was distorting capital spending flows, so the economy was in much worse shape. And so for us, this was a really bad time going forward for equities. The equity risk premium had been wiped out. We had academics getting rich by telling people there shouldn't be an equity risk premium, or it should even be negative. One can only hope that not too many people bought their books or their ideas. This was a tough time for anybody who had tried to learn the disciplines of this business. Probably it helped in my case was that I had been living in Greenwich from 87 on when I was a strategist for Wertheim, so I went through the crash. So I was aware of what happened when you could get even mildly enthusiastic. But what we had here was a whole new set of dogmas about the market, which basically said that everything you knew up till now is wrong. Throw it out. So on that basis, why would you say long duration bonds? Well, the answer to that was that ever since the end of the Cold War, what we had entered into a period was where the prime challenge to the price system would come from deflation, not inflation. Look, we got a 1,000-year record of price statistics. And what was interesting was the longest period of sustained inflation in 1,000 years was 1939 to 1995. The reason for that was we went straight from World War II into the Cold War. In general, there have been no sustained periods of price inflation, none, without a war. They've been very short-term. Furthermore, even those short-term ones were always led by a combined move in foods and fuels. Back in the medieval period, it was like things like charcoal, but it's amazing how well they correlated with what we saw with the energy crisis. So we believe that the end of the Cold War and the advent of peace was going to mean a situation roughly like the late 19th century, Pax Britannica, where the primary challenge to the price system would come from deflation. Our view, the emergence of China as China kept on growing was going to mean that ultimately China was going to become a price setter in a wide range of products. By the way, a friend of mine who's just back from China says they're going to soon start setting the world price on servers. They're already exporting more computers than Japan. So we looked at this, plus having a bunch of central bankers who'd learned their business fighting inflation, demography, and by the way, again, very short periods of price inflation over the millennia have been where you had a huge increase in the birth rate and the survival rate because you had all those people who needed food and housing and they weren't producing. So all of these things said this was going to be a period where the risk was going to be deflationary. And therefore what you wanted was long duration assets. Cash was just not an appropriate asset in that kind of environment. So that's basically where we've been for some time. And I was going to tell you that at 51%, I was prepared to consider moving that up once we completed the triple waterfall collapse for NASDAQ. My target on that was where it all began, 3 years ago. It began roughly in this town, too, when the Fed panicked in response to the long-term capitals thing and started flooding the system with liquidity. It took the multiple on NASDAQ. But I was also still resigned to the fact that people were going to still keep talking about the risks of inflation. Look, such inflation as we've had has come from moving energy prices back up to where they were, which is a level that will encourage exploration again, and from the Democrat tort lawyer payoff tax on cigarettes. Other than that, we managed to get unemployment down to 4.5% without re-triggering inflation. We've had the longest economic boom on record. The world had changed. See, when you don't have war, what you have is you let the trade system really work. You don't have embargoes. You can find the lowest cost producers. You can access markets. All those lovely things happen. If you doubt that, I just give you 2 textbooks, Pride and Prejudice, Jane Austen. The Bennett sisters inherited $1,000 in 1804, on which they invested in the 4% war bonds. That was enough to maintain a gentlewoman back then. Sherlock Holmes, the Copper Beeches Mystery, 1897. Violet Hunter consults him because she got a job offer at 45 pounds a year, which is more than a gentlewoman needs. Yes, there were periods of inflation in the 19th century, always with wars, always followed by deflation. So, therefore, by the way, most of the time, the British consuls, the perpetuals in that century, traded below the cost of overnight money. You wanted to lock in an assured return. That's where we were. What changed on September 10th? Well, the optimistic view is that this is just a new kind of war, and we're going to get these guys, and we're going to go back to where things were. Let me suggest another interpretation. Let me suggest that this is not a new war, but the oldest of wars. 2,500 years ago, the Greeks taught us, gave the world the concept that truth was beauty, that man was a rational animal, an independent soul, and that the highest of human callings was to search for truth. And there was a unity between the search for truth in mathematics, science, art, aesthetics, philosophy. Then came the Judeo-Christian era, which added to that the concept of the covenant of God with Abraham, and then the covenant universalized through Jesus, which said that we had free will. We operated in this kind of overall environment with human dignity. And that Judeo-Christian thing, those were the twin towers of the West, the Western intellectual tradition, which has given us the kind of world we live in today. Well, those twin towers came under attack first from the barbarians, and at various times over the last 2,000 years, they've been under attack. Napoleon challenged Britain, and because one of the things about Britain was that it was practicing what we now call capitalism, which was part of the Protestant Reformation and of the Enlightenment, which still maintained that basic tradition. He dismissed Britain as a nation of shopkeepers, lost the war. What we see now is that the Cold War was basically about another part of that war, because the Marxist nihilists basically wanted to destroy those twin towers of the Western tradition. That was what the war was all about, and we won that war. So I was one of the most optimistic of all strategists, I guess, during the 90s, in my view that I accepted Francis Fukuyama's view that we really had come to the end of history. Got that wrong. What happened on September 10th was we found out that there is a new set of successors. They were there to those who want to challenge the twin towers of Western civilization. I don't think it's any coincidence that they destroyed the twin towers of Wall Street. Because what we have here is a group of successors to the old diabolic types who, they're not cowardly, they're not mad. They truly want to destroy what we have created. And therefore, getting rid of them is going to be an extremely difficult process because they are among us. This is not the old kind of war where you could just attack them over there or Even the Star Wars type of war where you could zap them from 300 miles away. No body bags. So what that does is introduces a new kind of fear. Because what makes peacetime so lovely, so ironic, is the fact that we can carry on our lives without fear. We even in the 1990s improved on being able to live in the cities without fear of crime to the same extent. I came through O'Hare Terminal yesterday morning. It was like O'Hare is at around 2:30 in the morning, and I've been there because of flights being delayed. The flight over here, 3 flight attendants, 12 people. The limousine driver at White Plains told me they ordinarily take in $7,000 a day. They're taking in $1,000 a day. He said very few of us we left within 6 weeks. America learned in the 1990s to outsource its production. That's what the trade deficit is all about. And what's one of the reasons for deflation is because we've been able to outsource our production to the lowest cost producers. What that meant was we created jobs in areas of services which rely on people's willingness to go out and use those services or have them delivered to them. And a lot of these can be deferred. So to the extent that this war involves the sense of fear, what you can do is to certainly change for enough time to do serious damage to the economy, people's consumption patterns, living patterns. And this all at a time when I certainly concur in everything Doug had to say about consumer debt loads and all those other things. In other words, we excesses. What we didn't need was something which would be an attitudinal shift, a sense that this is something that all the king's horse can't save us from. Or if they do, it's going to take a long time. So what that suggests to me is that the equity risk premium has to be adjusted upwards until such time as we can say we have peace. This could be a very long war. I don't know how productive those warnings are for investors because, as I say, the record of investing in wartime is very low, very compressed, particularly since we're coming off sky-high levels of equity risk premiums because of the concept that peace was here to stay. Now, sure, it's a different kind of war in the sense this is not, it doesn't look like it's going to be extremely expensive to fight, like World War II or even the Cold War. But that's not so much the issue as the sense of personal freedom, the sense of opportunities for your time and your money and your intellect that happen under peace. You know, the phrase is peace and prosperity. Yeah, there's a funny linkage there. It's not just a political thing. This is what I'm promising you. So what this suggests to me is that until we can reassure the American population that we've really choked off the terrorist cells in this country, what we've got is a situation where all sorts of the kinds of jobs that we created in the 1990s are gone. It's not just a matter of bailing out the airlines. It's a matter of, and at O'Hare, they calculate that for every flight that lands and takes off, one job is created around the airport. Well, that tells you how many jobs are disappearing right now. So this is a big, big change. And even business travelers, well, eventually business travelers perhaps will get back. I happen to think it's safer to fly now than it's ever been. But what you know is that if you're going abroad, you have the risk of not getting back because of war interventions. My brother-in-law was at a conference in Beijing. The only reason he got back on time from the conference was he was ticketed to come back to Canada on the day the conference ended. All the other people who was planning to stay over a couple of extra days, they cannot get out. Now, Beijing's not a bad place to be, but what it is a point that people are going to understand that the kinds of easy ways they made their arrangements are now subject to a level of risk that they may find intolerable. So for all of those reasons, I think we should go back to where, frankly, we were up until this year, which is the 40% equity level. And what you emphasize within that is the groups we have right through that period. See, one of the reasons we were so scared of the market was it had such weighting in groups for which we had no confidence in their numbers and very little confidence in their management. These are supposedly hot shots, and they couldn't manage accounts receivables or inventories. What they were best at was using stock option profits to inflate their earnings. So what we've emphasized is energy, right at the top of the list, right through this period, defense, and, by the way, red meat. There's only now one red meat stock left, and that's Smithfield. That's a sort of a quirky one. But there's terrific companies in here. They're not subject to being driven out of business by Chinese competition, and we're going to need their services. I don't know where the price of oil is going to be at various times the next 6 months, but I know the market never paid for $32 oil. And last year, we grew our rig count for natural gas by 40%, and we grew our production by 2%. The law of diminishing returns is in there big time. So the financials and what makes this bear market unique, this is the first bear market where the financials didn't lead it down. Absolutely amazing. That was the single most reliable indicator I had for 20 years as a strategist, was the relative strength of the NYSE financials to the S&P. Didn't work this time. They outperformed. Banks were, in the first 7 months of this year, the 9th best performing group in the S&P. Absolutely astounding. It shows you that the Basel Accord, plus deflationary forces that prevented inflation coming back, plus one dares to hope that bankers have learned from their experience, have meant this a better group. One thing I can tell you is when you come out of past bears, the group that outperformed going down always outperforms coming back. Corollary of that is the technology stocks, when we do turn around, are not going to lead us out. They have created so much of these problems. They've created so much of these excesses. And I suspect that the technology that's going to be emphasized now is technology that makes us feel safer and actually be safer. Identity systems that allow immigration officials instantly to check on whether somebody is who that person claims and communicate to a central database so that we don't have people coming into this country and finding out months later that they should never have been admitted, everything being done by hand. I go back and forth across the border to Canada all the time. And the process is medieval. And that means, of course, lots of people, bad people can slip through. So I think we're going to maybe use some of these gizmos. Instead of having gizmos so that anybody, anywhere, can, with a handheld gizmo, buy jute in Dhaka or trade buns in Germany around the clock, I think we're going to find ways of using technology to make us safer, to defeat these types. But all that's going to take time. So it's the technology that's going to be the big winner in the next 5 years. Most assuredly will not be the kinds of things that we had during this period where everything seemed so wonderful and we had the Pied Pipers, the shills, and the mountebanks telling us it didn't matter what you paid for these things. So it is a different kind of world. We've lost a lot of our illusions, but ultimately the record of 2,000 years is those who attack Western values never win. Although, as we found with Nazism and communism, they can look like they're winning for quite a while. Thank you.
Well, thank you very much. Spencer.
Such a delightful place to be and clean up after that lineup. If you noticed the sign on the door when you walked in this morning, over that door right up there, it said creepy crawly things. And you might have thought that it referred to the exhibit around the walls here. Little did you know we put it up this morning to describe the panelists. My perspective at Common Fund is a much longer term than Spencer's, but I tend to agree more with him than I do with Doug or Don. And I just want to amplify on a couple of points, not repeat too many. The fiscal stimulus that was going on before last week was pretty astonishing. We were putting $38 billion back into the economy in terms of tax rebates. The number that's going to be spent on reconstructing Lower Manhattan, hopefully not the Trade Center, but at least the infrastructure underneath it. The security measures, the additional sky marshals, all of the things that are going to be done to move the important business of the country forward are going to multiply that $38 billion several times over. These are big, big numbers. We were projecting an increase in the third quarter GDP on the basis of the tax cut of between 0.5% and 1%. eventually the spending that's going to come out of Washington will have an impact on the economy, and it will go through. There's no way you can ignore the fact that we are going to have a huge injection of liquidity into the system, both from the Fed at the monetary level and at the fiscal level. And if there's one good thing that came out of the events of last week, we are no longer talking about the nonsense of raiding the Social Security lockbox. There was never a standalone fund that was hidden from the rest of the federal budget. It was a complete fabrication for political purposes, and the fact that we're no longer talking about it is probably the best thing that's happened. To look at our market opportunities and asset allocations, you have to start with the yield curve, and Spencer's already started you off on that. But I want to look at first the shortest end of the curve. Treasuries at the shortest end of the curve are trading at 2.5%. That is nothing by historical standards, and given the rate of inflation that we're likely going to see, it really is nothing in real terms. One of the concerns I have for our investors is that people who are earning 5 or 6% on their cash operating reserves last year are going to look at this, they're going to feel a pinch in their budget, and they're going to stretch for higher yields someplace, somehow. The last time we saw this in size was in 1993. Many of you recall the events of early 1994 when the yield curve snapped back, and people who thought they were in low-risk, high-yielding vehicles found quite the contrary. So I think that's a message that I'm going to be sending to our investors is this is one of those areas where you don't want to push on a string and try to get more than the market is offering. As you build up off the yield curve, though, you have to ask yourself the question, do we expect the risk premium in equities to reassert itself? The answer, I believe, is yes, for all the reasons you've heard already this morning. And in the long pull, should we expect, and the long pull for me is 5 years, 3 to 5 years, should we expect equities to outperform the alternatives available in the fixed income market? And the answer is still yes. I didn't hear either Doug or Don say they were going to zero in their equity allocation. They were just getting down to the lower end of their comfort zone because that's where they felt you should be. I'm somewhat less bearish than that for a couple of reasons. One is that we tend not to be very good when we try to do market timing. The last time we tried this in a very similar environment was in 1990. The Gulf War had commenced. The stock market was an incredibly volatile and risky place, and many people loaded up on cash, thinking that they could get back in at the right time. If you recall the Gulf War or the re-invasion of Kuwait, it was a 48-hour effort that the market realized it was going to be a 48-hour effort in about 12 hours, and the stock market rallied by 10% in very short order. Everybody who was on the sidelines in their bunker, thinking that they could rejoin the parade in step, were sadly disappointed. And I have a hunch that people who try to be too clever by half in their market timing this go around may be similarly disappointed. So you have to be very, very careful there. On the subject of equity investing, though, I think this is also an opportunity to talk about the perils of indexing. We've seen it pretty seriously in the last couple of years as our cap-weighted indexes have just grown with several of the high-flying stocks only to come down pretty dramatically with our high-flying stocks. And what we learned, hopefully, from that exercise is the fact that the indexes are not always the market. Very few people can mimic, had a pretty good year. It was actually in positive territory. And it was just the largest cap stocks who held the largest weights in the index that drove the overall index down. I don't think we are out of that woods yet. I think this is going to be an environment where thoughtful stock pickers who shape their portfolios in a risk-controlled way are going to outperform the indexes, and the exposure that you want to get to the market isn't necessarily through either synthetic positions using futures or through index funds. But that's a risk that's kind of second-order small to the overall level of the market. This forum has traditionally talked about alternative investments. We haven't talked much about that today, but I think a couple of comments are in order. We are getting more and more inquiries all the time about hedge funds and market-neutral strategies. Obviously, relative to the general market last year, these funds did a phenomenal job in a tough environment. Consequently, everybody's reading in the paper, well, maybe I should have done that, maybe I should do that, and they're moving in that direction. The true risk-controlled market-neutral strategies, the ones that should aim for a couple of 100 basis points over T-bills, and have over the last 5 years earned anywhere from 8 to 12%, depending on how successful they were in the application of their strategies, are going to earn a lot less money this year. I mean, 200 basis points over T-bills is now a very low number. So if those market-neutral strategies are earning from 6 to 8%, we should not be disappointed. And my fear here is that investors who have come quite accustomed to earning nearly 1% a month with relatively low volatility are going to be leaning on managers to try to produce those kind of returns in an environment where it's just not conducive to do so. So again, we should lower our expectations across the board, and nothing in terms of market neutral or hedge funds are going to help us. The long-short equity hedge funds, however, I think have a great opportunity for the reasons I alluded to in my comments on index funds. I think this is going to be a stock picker's environment, and thoughtful, fundamental researchers who roll up their sleeves and do their homework probably can add value in this kind of environment. Volatility is awful for our psyche, but it's actually pretty good for trading opportunities if we keep our wits about us, and that's important. There are certain sectors like airlines that we've talked about a fair bit this morning. I would view buying U.S. Air or almost any of these airlines right now as buying a call. You're either going to have your time decay hit you and you're going to end up with zero, or you're going to have a real nice return. And if you go into those sectors with any other attitude than that kind of investment risk perspective, you're likely going to be disappointed in there. Final comment I want to make is about, I guess, my fundamental optimism here. This is a phenomenally strong country, and our greatest strength, which we haven't mentioned today, is our human capital. We have an entrepreneurial spirit and a great deal of creativity that has carried us through many crises in the past and will no doubt carry us through this crisis. If you walk around the room, in the back corner over there's an exhibit called the Purple Egyptian Scarab. And in the description, it's a sign of eternal renewal and continued existence. I couldn't think of a better metaphor. Unfortunately, it's not the U.S. purple scarab, but we may want to adopt it for a while, because quite frankly, I think that captures our spirit, our strength, and why I'm fundamentally optimistic for the long pull. We are not recommending to our clients to throw in the towel and get out of equities, but to stay with our creative spirit and our growth potential in the long run.
Thank you very much. Let me open it at this point to any comments or questions. We left you all speechless. Oh, sorry. Actually, just one mic. There's a microphone coming around. Hang on 1 second. Sorry.
Everyone seems optimistic that we'll win this war. But we have lost 2 wars in our history, the Vietnamese War and the war on drugs. And this one looks rather like those 2. What do you think?
Well, interesting you should draw those analogies, because the war on drugs is basically a value system war. And I began my remarks by suggesting that's really what is at the core of this one. It's not like most wars. It's really over something deeply fundamental, which is why to call these people cowards or madmen is so wrong. These are people who basically reflect that final Latin motto, dulce et decorum est pro patria mori. Sweet and seemly 'tis to die for one's native land. And these kinds of wars, then, tend to be really the most difficult. So that's notwithstanding that, as has been pointed out by Spencer, that the administration is doing a good job of trying to damp down people's expectations. One of the reasons America is a great country is it's impatient to get on with the job and show results. One of the reasons we have an investment management industry like this is because, notwithstanding all our fine talk about long-term investments, we get measured by short-term returns. And so what I don't know is about the ability to endure if, for example, we get another terrorist success, like if you watch that movie 2 Minute Warning, watching the terrorists go at the Super Bowl.
A success like that, I think that the airports will be where the next attack will come. It'll be somewhere else. You cannot defend everything in an open society, and that's really, it's the open society, it's our value system, we're under attack. So I would love to share your optimism about this. One of the first errors in most wars is underestimating the enemy. This is an enemy that has a belief system that is as strong as our own. And you got to respect that and fear it. They're going to be around. I mean, you can kill off a few of them here and there. But remember, these Islamic cells have been fanned by extremists now for about 25 years. They've been multiplying across the Islamic world and indeed right into the United States where you've had them going. So what you have is that if you think about the success of fundamentalist Christian sects that people would have underestimated, like the Mormons, what they've had is enthusiasts willing to give up their time to promote something. Now, these are wonderful, ordinary, but what you can see is that beauty always has its opposite, which is evil. And so if you look at the diabolic side of this, the same sort of power means that these conversion systems have been at work. And remember, they have 5 babies per family, these kinds of numbers. They've got youthful democracy on their side. We've built up a huge number of people who truly hate us and who believe that their quickest ticket to paradise is to die killing us. It's very hard to fight an enemy where part of their reward system is that they die.
Are there any other questions or comments? Steve.
The mantra in the late 90s has been an intergenerational transfer of wealth, privatization, Social Security, aging baby boomers contributing to 401ks, and that was the fuel that led our growth. What do you see to those? Are those arguments dead, or are they still dormant?
I think my understanding of demographics suggested that somewhere 2006, 2007, 2008, they would actually start turning negative towards equities and basically long duration financial assets. The reason being, and this is very, very simplistic, but if you look at a simple ratio of the percentage of the population in their 40s versus the percentage of the population in their 20s, we in our 40s have been running far ahead of those in their 20s, but that inflects around 2007. And the reason for focusing on that is, as many of you may already know, and I will soon find out, people in their 20s destroy wealth, people in their 40s create it, and when we start having a bigger part of our population in the destroying category, it's not good news. We got to pay for them to go to school, then we got to pay for them to set up an apartment. Then when we stop paying, they start going to financial institutions and borrowing. To me, that was one of the big negatives of the 70s when I was in my 20s, that we greatly overwhelmed the savers in society and borrowed, anyone that would lend us anything would take it. So I think we're not there yet, but we're moving in on a time when I believe demographics are actually not positive for long duration assets. And then to the second point on 401k programs, I guess going back to a statistic I cited earlier, I think there was a great case for 401k programs supporting equities, but I think the average manager of their own 401k program basically got very, very imprudent with their asset allocation, went way too far in the direction of equities, and I'm afraid that that's probably more real right now. I think, the S&P 500 finished 1998 at 1229. I don't think there's a snowball's chance in Houston we're going to finish this year at 1229. So that means we've gone 3 years now where you've basically lost money in an S&P index fund. I think
there's a risk that we really do get a very meaningful asset allocation change by, my brother and sister, people that aren't in this industry over the next 3 to 6 months. And it might be temporary, it might be semi-permanent, I'm not sure, but I think some of those big picture trends that have been very, very supportive of equities in the 90s, I'm afraid there's a more solid analytical case suggesting they're going to start going the wrong way rather than the right way.
3 points on that. Between 1985 and 1995, the number of 25-year-olds in this country fell by 1/3. As Doug pointed out, that's the sort of median age for people leaving home, buying houses, cars, furnishings, creating all that demand. As long as they stay at home, they just add extra demand for the phone. So that's changed. Number two, as regards to the attitude of the 401k, I'll give you 2 possible arguments. One is that a good operative definition of insanity is somebody who repeats the same experiment over and over and over, expecting each time it'll turn out differently. And what one doesn't know is at what stage at which the people who've been losing money consistently as they put more money in their 401ks decide that's the trap they're in, even though that isn't a fair way of looking at it. But third, we come back to what 2 of the speakers referred to, which is one who's made this country great is a set of belief systems. And one of those belief systems is that that's gradually developed, and it's come back every time, is that if you buy stock, you're buying in the future of America. And so that in a funny sort of way, maybe this kind of spontaneous demonstration of patriotism that we're getting here will say to people, well, I'm losing money now and may lose money for a while. We're going to win this, we're going to come back, and I'm going to be rewarded for this. In other words, I'm on the right side. So I think it's going to be the playing out between those 2 things that will define the answer to your question on the 401ks.
In the fall of '98, the last time the world was coming to an end, probably the best thing that saved most of my investors was the fact that there are committees, and committees don't meet very regularly, and when they do, they can't make decisions. The real question here is whether or not the individual investor loses such confidence in just what Don was talking about, so that they fundamentally change their monthly deductions. I don't know anybody who has changed their 401k allocation. There are some signs that there is a patriotic bounce on Mondays, people opening accounts at Charles Schwab, but I don't think any of those are relevant for the time being. We just got to watch this pretty closely. And I suspect people will no longer be asking me the question that they were asking 2 years ago, which is, why do I hold bonds at all in my portfolio? I think we've got enough evidence on that score now that we should put that one to rest for a while. But I fundamentally agree that people do believe in the long pull, and if you're 25 to 45 years old, you're probably not planning on retiring anytime soon, and you have a long-term investment in the country and the companies that make it up. So I don't think we're going to see real fundamental shifts from a general equity orientation.
Spencer, I know about 401k allocation. Hewitt tracks on a day-to-day basis how their database tends to be skewed towards large corporations, but they track movements. And on Monday, about $1 million moved 401k accounts from equities, highest ever by far. 9 times more volume than normal. So I think some sort of unfounded belief that working Americans are happy to be in equities is probably unfounded in the short term.
Spencer, I think it's appropriate to have the last word if you'd like to have it. If not, no, fine. Well, listen, let me thank our 4 panelists. God bless America. Yes, thank you. And let me thank our 4 panelists for their insights and for framing these issues and for their ultimate optimism as well. And before we do close, let me just mention quickly our next session in October will be on the geopolitical and investment implications of U.S. policy. We have Congressman Christopher Shays, who is joining us on that day, as well as Ash Carter from Harvard's Kennedy School of Government. And before you all go, let me just turn it over to Steve for one last word.
Thanks, Ron. we started this forum 6 years ago. Alon, Lloyd, you remember we were out in Crested Butte. We had a speaker there, a fellow named Jeff Lowe. It's a high altitude climber. I like to bring these sort of off the beaten path kinds of speakers in. Jeff said at the time, when asked the question, what's the greatest risk in climbing that you see? And Jeff looked around. He says, the greatest risk I see now is that I lose my humility. And I think that's more true than ever. Cantor Fitzgerald was our founding sponsor of the Greenwich Roundtable. And I'd like to have a moment of silence for Cantor and Cantor's people and our colleagues. Thank you very much.